Yesterday we had a series 1 in which we dealt with the 3 accounting standards, AS1, AS2 and AS7. And today we are going to discuss 3 more accounting standards, AS9, AS10 and AS16. AS9 revenue recognition, AS10 accounting for fixed assets and AS16 borrowing cost. To give more insight into these accounting standards, we have with us today CAS Sundaraman sir. On behalf of SARCF ICA and all the members present here, we welcome you sir. With a big round of applause, welcoming Shankaraman sir to come and occupy the dais please. We will start today's proceedings with the invocation of ICA motto. Let us all rise for ICA motto song as a mark of respect to our mother institute.
Yaesha sukteshu jagrati Yaesha sukteshu jagrati Kamam 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 pursho nirvimana Tadeva shukram brahma Tasmin lokaha sarve tadunatyati kashchana etat dvaita etat dvaita etat dvaita etat dvaita etat dvaita etat dvaita.
Thank you. Please be seated. Let me introduce today's speaker. Actually, sir's profile is running 2 pages, and it's my bound duty to briefly read the important aspects of his profile. CAS Sundaraman is a fellow member of our institute. He is a practicing chartered accountant and having around 12 years of experience in practice. He has completed all stages of CA in first attempt. A big round of applause for that. He is a commerce graduate and a topper from Ramakrishna Mission Vivekananda College, Chennai. He learned Sanskrit at higher secondary level and emerged as the state first rank holder in Sanskrit. Sir, for your kind information, I am also a diploma holder in Sanskrit, higher diploma holder in Sanskrit, Indian Vedic language. I can chant slokas and mantras. By the way, I am Rahman. Out of my interest in Hindu mythology, I learned Sanskrit. Let me resume the introduction part. Sundaraman is a consistent academic performer and remained as a topper throughout his schooling and secured 96.25% in class 12 public examination. He is also a registered valuer for securities and financial assets regulated by Insolvency and Bankruptcy Board of India. He is specialized in the Indian corporate laws and Foreign Exchange Management Act. He is presently one of the partner at Mrs. G. Shekhar and Associates. G. Shekhar sir is a former Central Council member of ICI. Sundaraman sir's area of practice includes corporate law compliance, NRI taxation, FDA advisory, business valuation engagements for takeover and investments, accounting standards advisory, direct and indirect taxation compliance, system design and implementation, tax litigation management, capital structuring, etc. He is a national accredited trainer for Indian GST law, accredited by National Academy of Customs and Indirect Taxes, Ministry of Finance, Government of India. He was a member of Chennai Citizens Forum, a not-for-profit think tank association. He was a co-opted member of ICI Delhi in the Corporate and Economic Laws Committee. He was also a co-opted member of SARC's Corporate and Allied Laws Committee as well. He is the faculty for Corporate Law, Business Law and Allied Laws for Chartered Accountancy course at various private institutions. He was the member of Academic Council of MOP Vaishnav College for Women. He was also in the Board of Studies Management and Commerce Division of Stella Maris College, Chennai. He is a regular visiting faculty for SARCF ICA and its branches for CA Inter and CA Final courses. Direct Taxes, Regional Training Institute of National Academy of Direct Taxes of Income Tax Department, Ministry of Finance, Government of India. He is also a faculty of Regional Training Institute of Comptroller and Auditor General, Government of India. Regional Training Institute of Central Board of Indirect Taxes and Customs, Ministry of Finance, Government of India. Faculty for Corporate Law and Accounting at MOP Vaishnav College for Women, Chennai. Faculty for the PG Commerce and Finance students of Stella Maris College, Chennai. He has been actively participating in various debates in media and public forums. To name a few, panelist in budget and other legal sessions of Tandi TV, Sun News, News 7, News J, Pudhiya Thalaimurai and other medias. He is a public speaker in GST for the Trade organized by Dinamalar Tamil Daily. Speaker in trade forums Vanigar Sangam at district and state level on union budget, GST and Indian taxation. He is a writer of articles of professional interest in journals of SIRC and its branches. He has been addressing various schools and colleges in the subject commerce as a challenging career option. That's a great CA brand building exercise you are doing, sir. Thank you very much. And he is a speaker at Continuing Professional Education Committee of SIRCF ICA in Corporate Governance, Companies Act, Independent Director Regulation, etc. He is a speaker at Young Entrepreneur Institute, Sivakasi, on business and financial planning organized by young entrepreneurs. He coordinated the help desk for e-filing of IT returns organized by Income Tax Department, Chennai, when e-filing of tax returns was introduced for the first time in India. With this elaborate introduction, let me present before you CA S. Sundar Raman sir to handle today's session. Before I hand over the podium to sir, may I now request Vikram Surana to come forward and present a shawl to Sundar Raman sir. Requesting CAV Srinivasan to come forward and present a memento to Sundar Raman sir. Over to Sundar Raman sir to take us through AS9, AS10 and AS16. Over to you sir.
Respected senior members of the profession, fellow members of the Institute of Chartered Accountants, humble pranams, very good evening to all of you. I thank the SIRC for this wonderful opportunity again. As Mr. Rahman was pointing out, maybe after the post-COVID session, post-COVID period, this is the first time back again to the alma mater for, as a participant I have always been there. Used to be continuously grab some opportunity whenever some slots are available for handling a session. And after nearly I think 2 years back again to the stage, this time at this side, for sharing knowledge on this very important topic on the accounting standards for the non-corporate the entities. Now, again, at this junction, before we get into this particular topic, I would like to just take probably a minute of time on stressing this, the importance of this particular topic. Again, many seniors who are here, very happy to see them, whose experience is more than my age. Happy to be part of this interactive session, meaning I would like to get a lot of inputs from your end too on the various the provisions, whatever the practical experience of the implementation of these standards which you would have come across on your the experience. Now, accounting standards by and large over the decades of its the implementation and development. Today, we have accounting standard itself in multiple phases. I used to, being part of the faculty for CA students, when I was used to attend the accounting classes, the faculty used to say that he wrote CA exams, what you call the first generation accounting standards. There are only 15 accounting standards, and thereafter Institute introduced the second generation accounting standards, which is from standard number 16 onwards. But today when the students write the exams, the standard itself is in multiple form. We have the ICA accounting standards, and we have the Ind AS, and further the standards are not just only with respect to the accounting. And the Institute came out with recently what we call the valuation standards, where the more importance on the valuation, the separate what we call the valuation course is being floated, the guidance of the IBVI, valuation standards. So you take the core 8 subjects in the CA final, almost we have standards for all, including the information technology standards, what we call the PUBIT. Now, with this growing importance for the preparation, the need to prepare a very qualitative financial statements, the importance of the accounting standards is not just only with respect to the corporate entities. And therefore, from as a practicing chartered accountants, we need to be more preparative in our note, some sort of greater transparency, because always as a non-corporate entity, sometimes we are little jerk in disclosing more information on the face of the financial statements, considering the department and other information. So as and when it comes, probably the idea is always need-based disclosure of the information. But nevertheless, the Institute has made it very clear in the 2016 Council decision, the accounting standards are applicable for non-corporate entities as well. So you prepare the financial statements for a proprietorship entity, you prepare the financial statements for even a partnership firm, of course on the basis of the level 1, 2, 3 today, of course, except for quite a few standards, the first generation standards if you take, it's applicable for all the enterprises as such. Even the smallest 10 crore turnover company also are covered substantially with all these standards. Again, the need is the focus of the, more particularly the Ministry of Finance, the government on the chartered accountants. Day to day have been more sophisticated, the expectations, including the recent bomb on the inclusion of the chartered accountants, company secretary and the cost accountants as a reporting entity under the Prevention of the Money Laundering Act. Now, it is just only a 4-line notification which has come, but somebody who have gone through probably the entire standards, the entire law of the money laundering, more particularly on the rules relating to the reporting, would probably be aware that as a chartered accountant, you are required to blow a whistle, report on the transactions which are being carried out on behalf of the client with respect to the formation of the company, and assisting them on use of your maybe premises as the registered office for some of the companies. They used to be very common in Mumbai, and if you find even more particularly the advocate office of esteemed the legal practitioners even would be used by many foreign companies even today as the registered office, despite the factory would be in the other state. They are required to make a reporting to the money laundering, what you call the financial intelligence unit, and more particularly suspicious transactions, reporting of suspicious transactions. Now, during the course of your practice, if you have come across any suspicious transactions, you are required to blow your whistle. And these are going to be with huge ramification. If not, you probably would down the line would really feel that whether the COP may be required or not would be even the situation. So enough representations are required to be made to the institute on implementations. Already a news article have come Ministry of Finance also have responded by saying that there is something called the Financial Action Task Force. At the global level, the G20 countries have decided by way of resolution to bring professionals inside the ambit of the BML as a reporting entity. I would like to start this with the background, again stressing upon the need of how watchful, not just merely from the execution of the compliance, but of course from the other reporting structure also the importance. So the non-corporate entities which constitutes today, if you see on the base of the GST registration data, if you take all over, which is the core number of people actually doing business in India, nearly 80% of the people, 80% of the SSEs, if you take the GST registration data, are proprietorship and partnership firms. And of the remaining also you find substantially the small private limited companies. So if you consider the bunch of financial statements which are prepared is actually towards in respect of the non-corporate in terms of number. Maybe the size would probably will lead upon to the company form of organization. But in terms of number, if you see, it falls under the non-corporate entity. So the need to prepare a qualitative financial statements is always the expectation of the government, and therefore, irrespective of probably these standards are always form and part and parcel of your implementation. These are what you call the first generation standards, basics of your accounting standard 9 or the accounting standard 10 or 16. But of course, these sessions would probably any number of times, even if you read, maybe there could be a small paragraph which would come as an highlight to us and will make a small learning and improvisation out of that. So with this particular thought, the introduction, the need to prepare the qualitative financial statements and as well as the government's the expectation, I thought I will straight enter into today's subject. First, I would like to touch upon the standards relating to property, plant and equipment. Then I will move on to the other two these standards. Now, this standard, previously called as the accounting for fixed assets, have undergone a revision, and previously depreciation related provisions are covered by your standard number 6, and standard number 6 has been deleted, and it is both the aspect relating to the fixed asset, the capitalization, recognitions, as well as the measurement related principles, together the depreciation are now covered by the title property, plant and equipment related standards. This standard broadly covers the accounting in respect for all property, plant and equipment, unless and otherwise some other standards which specifically talks about the recognition of the, for example, AS 19, where which talks about the accounting with respect to lease assets. So unless there are separate accounting standards which talks about the recognition of any other property, plant and equipment, this standard covers all the accounting with respect to property, plant and equipment. Now, the standards covers with respect to PPE, property, plant and equipments, recognition, what you call the initial, when you recognize the asset as a property, plant and equipment item, carrying amount, determination, measurement of the carrying amount of the asset, methods of providing the depreciation, and of course the impairment, which are of course the impairment is governed by a separate standard, the AS number 28. These standards does not apply to the biological assets related to agricultural activity, because there is a separate accounting standards with respect to the biological assets and agricultural which is proposed. And of course, most of the non-regenerative resources like the mineral rights, mineral reserves, exploration and extraction of mineral oils, these are kept outside the purview of this particular standards. The first and foremost principle is to have a grip on this particular term, property, plant and equipment. When a particular expenditure, which are capital expenditure in nature, would come under the purview of this particular standards, property, plant and equipment. The definition says property, plant and equipments are tangible items. Two important conditions: A, yield for use in the production or supply of goods or services, or as rental to others, or for administrative purposes. Held for sale versus held for use. Where an item is held for sale, the ordinary course of business, it comes under your inventory. It is held for use for the purpose of production or supply of goods or services, as rental to others. It is an item, more particularly an investment item, which the expectation is only you fetch a rental income, not with respect to the core activity of the production or supply of goods or services, or even for an administrative purposes, including your other part of, because production with respect to supply of goods or services covers your core part of your production, other administrative parts, including your accounting department or the property, plant and equipment covered by other supportive department functions would also come under this particular definition, and expected to be used during more than 12 months. Now there are two important conditions here. First and foremost, he stresses on, while recognizing, this is the recognizing criteria technically, held for use in the production or supply of goods, and when basically an expenditure which is incurred by an entity would be capitalized and called as a property, plant and equipment. The significant word that has to be captured is what you call the future economic benefits. When do you recognize an item as a PPE? Whether it has a future economic benefits. And that particular item is expected to be used again for a period of more than 12 months. The recognition criteria. The property, plant and equipment shall be recognized as an asset. Para number 7, very important para. It is probable that future economic benefits will flow to the enterprise. You buy a machinery, you use the machinery in your production process, and that helps you in producing the finished goods. You get an sales out of that. That's a future economic benefit. Now, let me give two examples. We faced this issue in one of the enterprise. An enterprise which is a big car manufacturing company based out of Tamil Nadu. They constructed a bridge spending 20 crores. The advantage of construction of this building, this bridge, is to facilitate, shorten the distance of travel so that the goods can be brought inside the factory by traveling some 500 meters instead of another 4-kilometer radius. The construction was done outside, not on the property belonging to the company, not on the title, meaning technically bridge means you then immediately go to the land and then say where the title is. The sum and substance is that the land does not belong. There is some arrangement with the local villages with all the proper approvals with the PWD and things. The bridge construction was bound by the company, not on the title belonging to the company. But the arrangement is it can be used again by the local villages as well as by the company. There is no exclusive right of use only for the company. But it was purely sponsored, purely constructed by the company. The question is now this 20 crores which is spent, is it come under the definition of property, plant or equipment? Expenditure of capital in nature or not? Or it should be revenue, debit to the P&L. The most important question, is there a future economic benefits? Notwithstanding, there is a value in use, notwithstanding the fact that there is a ownership title to it or not, notwithstanding the fact that there is a exclusive right to the company or not, despite the fact that it can be used by the villages as well. But is there a future economic benefits, and whether that benefits will go more than 1 year? So what are the economic benefits that would accrue? Transportation cost savage. Instead of a vehicle belonging to the company traveling for 4 kilometers plus by just crossing a small lake, that would help the company in achieving the distance and also other geographical advantage. Definitely there is a cost saving, and that would amount to what you call the future economic benefits out of the situation. Definitely. This would definitely be classified as a property, plant and equipment. And going by the definition again, go to the definition. Property, plant and equipments are tangible items held for use in the production or supply of goods or services, or as a rental to others. In fact, for using the land, they are required to pay a rent also. So there is one time there is a capital cost also. Every month they are required to also pay a lease charges, or for administrative purposes, and expected to be used during more than one period. So this prima facie does not answer the requirement which we discussed, but look at the recognition criteria. When such an expenditure should be treated, recognized as an PPE in your books. Property, plant and equipment shall be recognized as an asset. Para 7. It is probable that a future economic benefit will flow to the enterprise. Now, another example I would give. The same situation, because there is an usage of some 2 to 3 acres of land of the local villages also. It is actually a group of villages. The property in that area is owned by some 100 people exclusively, and there is a disruption to them. So they submitted a proposal to the company that for consenting to construct a bridge, the company should make a local school and college within that particular domicile area, so that it is accessible to the particular villages. So the company agreed to construct maintenance is done by the Panchayat and other associations, but they have to just construct, handover and come. So they have agreed to do the construction of the school and the colleges. They have spent around some 5 to 6 crores towards that as well. This 5 to 6 crore, which is a building of school and colleges, is that falls under the PPE? Is that a PPE? Yes, it's a tangible item. But whether it satisfies the recognition criteria, is there going to be future economic benefits out of that expenditure to the company? Is that going to be a future economic benefits? Yes? Not very directly. Just I construct a school, handover and come. So it is a debit. It's an expense to the P&L, matter over there. More particularly, it could be your CSR, that's all, maximum. But not directly. Meaning you can probably give a very wider explanation by saying if you construct a school there, the local villages will get benefited, as a result of which they could, for 10 years down the line, those children will be your employee. That's a very remote, distinguished argument.
On the other hand, if I don't incur that expense, I will be able to construct the bridge.
Yes.
Isn't it the cost of constructing the bridge? Can I not take it to bridge?
Yeah, we validated that particular argument. But what happened in the given cases, if it needs to be treated together, then it has to be part of your building, property, plant and equipment as such. The question is now, there was an expenditure which is incurred. The idea is, should it be debited to the P&L or capitalized, we provide a depreciation, that's all. So, from a very most prudence perspective, as far as the school and college aspect is concerned, it is very clear that it was not going to be a immediate future, there is no any continuous future economic benefits arising out of that, and therefore it has to be expensed. That is a prudent logic. So, sum and substance, why I am trying to therefore stress upon this particular goal. In any test with respect to recognition, you need to be very wide in your thought process as to, it is not because always plant and machinery, because recognition of a PPE, the more challenging aspects like this would also needs to be tested. It is not just only with respect to your machinery, building, etc., which are very clearly and prudently being more available. And in fact, these nature of expenditure would also needs to be further, comes with the challenge of, okay, I recognize that expenditure, let's say that bridge. The further question comes also with respect to, how do I determine the useful life of that? What would be the depreciation therefore in respect of that would also be more challenging. But of course, we have the valuers, and of course the PWD rules are there, etc., to determine and provide a depreciation, or unless otherwise a rebuttable challenge exists for over a period of these bridges, etc., normally goes up to 30 years or 50 years, 60 years in some cases. Those types of 30, 40, 60 years, but with all you need to also consider the duration of the project or the company, whichever is less. It's that the period which you need to consider for the purpose of providing amortizations, etc. So I stress upon this particular important para number 7, which says that future economic benefits. And these criteria needs to be taken into account, not only with respect to the initial recognition, including for the purpose of the subsequent cost, subsequent capitalization, whether it's going to be an addition, replacement, or routine services. Routine services, more particularly, it will be your repairs and maintenance, may not be part of your, what do you call the PPE item as a capitalized item. Here, just because there is a usage over a period of more than 12 months, enterprises today buying even a mobile is worth 2 lakhs, 3 lakhs for the CEO. The question always comes with respect to capitalization, etc. These are also, flexibility is given with respect to the policy of the management. If you read more particularly para number 9, it says enterprise may expense item considering the immaterial item, an item to be immaterial. I mean, those expenditure which are less than 2%, 5%, are less than 1 lakh rupees. Mostly they have a fixed asset accounting policy would say that any expenditure less than 1 lakh rupees would be expensed off, etc. That can be relied on. Benefits from related assets. Now, these are another important item which needs to be taken into account, which against the interpretation argument placed by my good friend there. Related items. Sometimes the future economic benefits would not emanate directly from the item which is under question. Sometimes it may even come from certain other related assets. Take an example of your amount which is being spent for the purpose of certain installing a pollution control rated compliance equipment. More particularly, if the enterprise happens to be a factory or a chemical manufacturing company, etc., they need to install certain equipments. Probably without that equipment also, the enterprise can still run, but that would lead to a violation. But I need to spend on capital expenditure for the purpose of preventing and prohibiting certain emissions or converting those wastages into like your STP plants, etc., which would not overly support. Directly I may not get any future economic benefits, but for that the project would not run. But for that the core, the machineries or core property, plant and equipments would not fall. So therefore sometimes the future economic benefits would also get from the related assets as well. That point should also be taken into account, which is what you viewed in the first scenario. Below this definition, so small 2 lines which are again a very important line. Spare parts, standby equipments are recognized as PPE when they meet the above definitions of the property, plant and equipment. That is, standalone as spare parts could be recognized as a PPE if it has standalone as a future economic benefits and it is intended to be used for more than 12 months. If supposingly this condition for a spare part or a sub-item or a servicing support equipments does not meet this criteria, then it would be recognized as an inventory. It would be recognized as an inventory. Elements of the cost. Moving on to the third stage of the PPE. It involves, cost includes 3 levels of criteria. One is the purchase cost, which is your basic purchase price. You are importing a machinery, there will also be what you call as the customs duties and IGST now, the countervailing duties. But of course, if you are taking credit out of that, then you need to keep outside the purview of the capitalization. So non-refundable taxes alone forms part of the cost. Deduct all the trade discounts and other rebates which are available now. So this is the basic purchase price. The challenge would really come in the second element of the cost of capitalization. All other costs which are very necessary for the purpose of bringing the property, plant and equipment to a current situation and in a usable condition. All those costs, in fact we would say that this point is also an item for the purpose of determining, mostly let's take an example of not a PPE which is a purchased item, but if it is a constructed item, where as and when you incur an expenditure, you keep on adding those items to the capitalization. At what point of time you would stop? You would say yes. All such item of cost which is incurred till the time it goes ready for use, and also bringing the asset to the current location and the situation so that it gives the usable condition as intended by the management. Any cost directly attributable to bringing the asset to the location and condition necessary for it to be capable of operating in a manner intended by the management. Any other cost includes, the standard itself gives the following set of items: cost of employee benefits which are covered by your AS 15, cost of site preparation including backed up with relevant professional fees. For example, you engage a design and consultant. Take an example of your Chennai Metro Rail, classic example which you can visualize in the amount of technology infrastructure consultancy goes into that on a pre-operation stage. They engage a consultant, paid crores of rupees just for giving a technical consultancy on its smooth operation, the lot of software which goes to it in the automation process, etc. All those costs, it's not the basic, the engine cost, all the other costs also should go to the capitalization of that particular, the engine drive. Initial delivery and handling cost, installation and other assembly cost, and includes the cost of testing also. So as far as the cost of testing, what you call the trial run, where the relevant raw material and etc. And if there are any incidental income which gets generated out of that particular trial run process, that needs to be offset against this particular cost of the property, plant and equipment. The cost of capitalization at time 0, PPE, also includes the initial estimate of the dismantling cost. At time 10, let's assume a 10-year useful life period. At time 10, more particularly it happens in case where you are doing a project which are of 5 years or 10 years duration. Consider a company like infrastructure companies, sometimes even from foreign. They get a contract for 10 years, they come to India, a Malaysian company, they set up all the PPE for the purpose of doing some excavation, this, that and road laying. And at the time when they do the initial capitalization at time 0, the cost should also include the estimate cost of the dismantling that would happen at time 10. So initial estimate of dismantling cost, initial estimates of the site restoration cost, major inspection cost and cost of the replacement should also form part of your cost. Cost excludes the following are not to be considered as an item of PPE: cost of opening a new facility, inauguration cost, because already it is ready. Up to time it is ready only should be considered. Cost of introducing a new product, administrative and other general overheads which not generally we are selling, distribution, all, because it's all overhead generally comes after sometimes maybe the asset is, that's the assumption. Elements of cost, these are again challenging one. Initial operating losses which are need to be charged to the P&L should not form part of the PPE. Abnormal losses and profits in case of self-constructed assets. Incidental operations during construction period. For example, I am doing a construction of a big mall, and it takes 3 years, 4 years, 5 years time, and there are phased manner the construction happens, and during such time I have open spaces where I permit some event happening, I permit some car parking facilities, etc. These are all maybe unrelated expenditure also. These are again not related to the core part of this, in fact will not satisfy the condition with respect to the capitalization to the PPE even, because these are not activity related to bringing an asset to the present location, condition, and for ready for the use. So these car parking income, if at all if you own, or the event, if you charge some rent for hosting a big event in respect of your vacant spaces which are available, minus the relevant expenditure should go to your P&L account and should not be added to the PPE cost. Payment is deferred beyond the normal credit terms. The difference between the cash price and the total payment which will be dealt by your borrowing cost standards. We saw this. Spare parts, standby equipments and servicing equipments. These are recognized in accordance with this accounting standard when they meet the definition of the property, plant and equipment. Otherwise, such items are required to be classified as inventory. In determining the cost, and another important aspect is how do you determine the cost when it has come for an exchange of an asset, exchange of another non-monetary assets or even a group of monetary assets. So if a PPE is acquired in exchange for other non-monetary asset or for a combination of a monetary asset, the general rule is it needs to be determined, measurement of cost needs to take place at fair value. Fair value of what? Fair value of an asset which is coming in or of an asset which is going out, whichever is more clearly and evidently available. Whichever is more clearly and evidently available. It should not be done at fair value, meaning which it should be done at cost of the asset which you have given up. Under the following two cases, that these are exceptions. The exchange transaction has no commercial substance. Now what is commercial substance in this? The exchange of an asset, when it has a commercial substance, the exchange of an asset is going to alter significantly the cash flows which are arising out of the project. Very significantly and materially. What you call the enterprise valuation gets disturbed. Then it does a commercial, so the standard gives an illustration on when it would be deemed as a commercial substance. So the situation is reversed here. When there is no commercial substance, then it need not be valued at fair value. Or fair value of neither the asset received nor given up can be reliably be measured. Then it has to be taken up at a cost of an asset which goes out, which is your WDV in the books. That will be considered to be the cost of the incoming asset also. If the acquired item is not measured at fair value, its cost is measured at the carrying amount of the asset given up. Carrying amount is nothing but original cost minus the return to value, the depreciation which it gets you a return to value. Now, coming to the subsequent cost and measurement. The subsequent measurement of the cost, there are two widely accepted methods, the cost model or the revaluation model, though traditionally, fundamentally we are, historical cost convention is the method which has set up in our mind. But if you read the arguments which are being put forth with respect to why someone should go for the revaluation model of the assets. Today as an enterprise, this is something which you need to speak and strongly look at companies which are in existence for 30 years, 20 years, etc. Sizable value of assets in the books, more particularly land and building, for example, and having a very thin balance sheet. Having a very thin balance sheet, need to demonstrate to the stakeholders the strongness of the balance sheet size by bringing those assets into the current value terms. Gone are the days where historical cost convention is the only method which is used for the purpose of recognition of an asset in the books. Asset means by and large, it will be always be considered as in mind as cost. Today, the standard permits you to recognize the asset under the current market value also. What you call as the revaluation method. But at the same time, this should not be done to window dress the financial statements as well. Therefore, enough care and caution has been taken to ensure that the revaluation should be done systematically, not in a very haphazard manner. Meaning that 10 machineries available, 10 assets are available, only one particular machinery I will do the fair valuation, rest of them at the revaluation model, rest of them at the cost, no. So the standard puts out enough caution. It needs to be reviewed periodically, the valuation period. When a particular segment of an asset in a category is revalued, the whole assets in that category needs to be revalued. Maybe a class could be, for example, furniture and fittings could be one class, property, plant, the machinery could be your one class, building could be your one class. So for building, land and building, you can go for revaluation model, and for the other assets, you can still go at cost. But within the segmented of the homogeneous character of the assets, you cannot have a bifurcation model. And this method has always been supported prudently on the higher side for the following reasons. Financially and fundamentally, if you see the providing depreciation being a non-cash item in the books, the fundamental logic of providing depreciation is twofold. One, write off the cost over its useful life, because the asset is being used in your business over a period of useful life, and revenue is being generated over the years, and therefore the cost allocation should also go over the period. Secondly, being a non-cash item, that particular debit would also help us to internally accrue the cash and fund the replacement of the asset. That's another financial management login with respect to the providing of the depreciation. Now, historically, when you capitalize the asset at 10 years and depreciate that particular asset on the historical cost which is capitalized 10 years before, you would probably internally accrue a cash which would only sufficient to replace the cost at 10 years before. Had you have revalued it and provide depreciation on that revalued amount, higher the debit in the books, actually it moves more prudent in planning for replacement of the asset at the current market value terms. So this is another argument which has been put forth in going for why a revaluation model needs to be prudently being followed up as well.
Direct depreciation is adopted in the income tax department.
No, that's for the books. Of course, for the purpose of income tax, you still go by your section 32 income tax rules, etc. But enterprise financial statements can disclose the asset at revalued value. Your land and building was 10 crores 15, 20 years ago, but today let's say it's 50 crores. You can strengthen your balance sheet by showing that at 10, 50 crores. But of course the depreciation, etc. on that particular land, of course no depreciation. But for the purpose of income tax, of course you add back and then less depreciation only on the basis of the tax rules. These are for the purpose of the financial statements, books, entities, financial statements. Can choose cost model or evaluation model as its accounting policy. Adopted option as accounting policy will apply to the entire class of the property, plant and equipment. Revaluation shall be done with sufficient regularity, as I said, to ensure that no window dressing of financial statements, to ensure that there is no significant gap between fair value and the carrying value. Under evaluation model, carrying amount restated with reference to available, observable market data. You need to engage the valuers. Today you have the valuers, you can engage, get a report from the valuer, and then rethink whether you need to go for the revaluation model, and there is a transition provisions available by which in that particular year you can go for the evaluation. Of course, one thing what you need to also done is probably over the period, if you have done continuous capitalization of other spare parts, this, that, etc. All that's now omnibus manner, it takes care into account in today's revaluation value. So all that needs to be taken into account in doing the revaluation. Obviously, you know that let's say a 10 crore asset is presented at 50 crores. That 40 crore what is available needs to be shown as a revaluation surplus forming part of the owner's equity. By and large, it becomes the owner's equity. But of course, the standards and the law takes care into account in ensuring that these are only unrealized profits and notional. Tomorrow you cannot withdraw dividend out of that, this, etc. There are enough protections are available in ensuring that you don't touch these revaluation profits for the purpose of, because our guy will do the valuation, show profits, and so tomorrow when cash is available in the books through borrowing, they will also withdraw it as dividends. So these are not free reserves. So there are enough, and even from an owner's entity. But today, from a non-corporate entity's perspective, we need to be a little more careful on recognizing these owners, increasing the owner's interest in the books of accounts by the corresponding increase in the valuation. As I said, the accounting would go like this. In respect of an upward valuation of the particular asset, the owner's interest will be increased by crediting the revaluation surplus. In case the asset which is under the revaluation now is being previously revalued less, because there could even be a revaluation higher or revaluation lower. In such circumstances, the increased value should be first used to absorb those depletion, and then the balance should only be provided for. In case of downward revaluation, the debit the revaluation surplus to the extent recognized previously. Previously you have done the upward valuation and there is a credit balance in the revaluation surplus. Now you are doing the downward valuation. The downward decrease should first go to your balance in the revaluation surplus, and balance, if any, is there, that should be debited to the profit and loss account. The revaluation surplus may be transferred to the revenue reserves. The asset is de-recognized, or is it used by the entity, not to the profit and loss account. Day-to-day servicing costs are required to be, of course, these are repairs and maintenance charged to the P&L. Some items involve a series of linked parts which require regular replacements at different intervals and have different useful lives. Now, the standard also talks about a very unique aspect of componentization, where an asset within the overall grouping of an asset, an individual component of an asset can be separately be classified as a PPE item. In case where these component has a separate marketability, separate future economic benefits can be generated out of that. For example, you buy a new asset, this particular part can be linked to that particular asset, in which case, even though this component cannot function standalone, it is part of the overall component, but the standard permits capitalization of that particular component alone separately, even though it may have a same useful life or a different useful life as well. See, component capitalization is another brilliant paragraph which is being governed by this particular PPE. Depreciation, of course, if you read the provisions of the Companies Act, depreciation is about, all logic it says, write-off of at least 95% of the cost over its useful life. As far as the non-corporate entity, there is no such logic with respect to 95, but in substance, you need to still take into account that same prudent principle, meaning 5% being the residual value. You need to target at least 95% of the particular, the carrying amount of the cost needs to be written off over the useful life of an asset. Depreciation begins when the asset is available for use. That is when it is in the location and condition necessary for it to be capable of operating in the manner intended by management, and continues until the asset is de-recognized. The residual value, the value that it would fetch upon disposal of an asset, upon the expiry of the useful life or upon expiry of the project, minus the expenditure that would be incurred for the purpose of disposal, would be considered as the residual value. So you have to arrive at something called as the depreciable amount. The cost minus this residual value is the depreciable amount, and that depreciable amount is what you need to write off over the useful life. In implementing the accounting standards with respect to non-corporate entities, as far as the companies, you have Schedule 2 which provides for the useful life, etc. But for a non-corporate entity, maybe a valuer's certificate or the judgment of the management, which can be benchmarked with the Schedule 2 requirements of the Companies Act. But it's not mandatory that Schedule 2, because Schedule 2 useful life is not applicable for the non-corporate entities. The residual value and the useful life of an asset shall be reviewed at least each financial year end, and if expectation differs from the previous estimates, the change shall be accounted for as a change in accounting policy. Some of the factors which needs to be considered in determining the useful life of asset, expected usage of the asset, expected physical wear and tear, technical or commercial obsolescence, legal or similar limits, expiry dates, for example. These are all the various combined factors which a valuer again needs to consider, or the management also, in determining what is going to be the useful life of the particular asset under question. As far as the standard is concerned, there is no restriction, and unlike your income tax law, which mandates the written down value method except in case of certain telecommunication license which can be written off over the useful life or straight line basis. Any method of depreciation can be followed, any method of depreciation which best suits the management given the asset criteria under question: straight line method, diminishing balance method, sum of digit methods, unit of production. The method selected should closely reflect the pattern of consumption of economic benefits. Mostly we settle down for the straight line method or the written down value method. But there can also be any other method, for example, where initially if you expect the amount of units which will come out of the particular production process is less, and if wherever you know that only, let's say, 1 crore units can be generated out of this particular asset, and you have a chart which says that your production process on the basis of the demand in the industry could be will face a graph, right? Low initially, higher in the middle, and then it will again fall. If you have a chart of the production units over a period of 10 years, your depreciation can also be on those lines. Extraction of the units of production method, which again only an estimate that you do at time zero, on the basis of the valuation. So the concept of depreciation is writing off the cost over the useful life, and that depreciation can be synchronized with the pattern of consumption of the economic benefits, economic usage of the particular asset under question. But once the particular method is exercised and followed, there must be consistency with respect to the following of this particular methods. The depreciation method applied to an asset should be reviewed. Again, just like residual value needs to be reviewed every financial year, the depreciation method followed by the management should also be reviewed every year. If there has been a significant change in the expected pattern of consumption of the future economic benefits, for example, if you are following the production output method, and then you find that the trend has changed, or you previously estimated that 1 crore unit would be generated, but no, it's only now 60 lakhs and 40 lakhs, you need to maybe rework your depreciable amount and depreciation accordingly. Such a change would be accounted for as a change in accounting estimate in accordance with your accounting standard. A change in accounting estimate would give only a prospective impact on the books. Component accountings, which is what we are talking about, useful life of components, you need to take into account the replacement cost, major inspection overall. These are all the factors which need to consider whether a separate component would be capitalized in the books of accounts. Each major part of an item of PPE with cost of being significant in relation to total cost of the item should be depreciated separately, even though it may not have different useful life. Lastly, the two items, one is the derecognition and of course the disclosures. When an asset is derecognized from the books, initial recognition which saw, so moment it is no longer generating future economic benefits, it will be derecognized. Or on disposal, or when no future benefits are expected from its use, then immediately you have to write it off in the books of accounts. So there was an enterprise, again, which were into initially manufacture of heavy car. That was a new concept which they brought it in Maharashtra. Above some 1,700 cubic capacity. Initially, they set up an 100 crore plant for manufacture and sale of that particular unit. Then there came up a law through that the environmental issues that this car above a particular cubic capacity cannot be sold. So at the time when I put a factory, there was the usage of that particular facility would only suit the manufacturing of that particular model of the car. Its mold, everything, and an automized process. The company did the operations for 1 year. They made a 400 crore turnover the first year. As long as, until this announcement came from the government, it was going concern. In fact, we are about to sign a balance sheet which has profits for the particular financial year. But before sign off the financial statements, in fact, the company went on to appeal before the National Green Tribunal further. But as on the date when they signed the financial statement, just a small announcement that car cannot be sold. And ultimately, what's the use? You put a plant for 100 crores, and it took them 7 years to fight it before the Green Tribunal, and after some compromise arrangement, etc., they need to change this one, etc., they have been given a permission. Years of accumulated losses. We don't know even whether, even though I am signing a balance sheet with a huge turnover and profits, the going concern itself is questionable, as on that particular day. So, parent facility is no longer going to generate a future economic benefits. No longer there is a question of held for use. The only objective probably the promoters are thinking is to dispose of that. That too, this facility is something very unique manufacturing where it cannot be readily be used for any other car company also. They have to scrap it out. So again, that is also another important aspect. No longer it is generating a future economic benefit. Any gain or loss arising from the deregulation to be included in the P&L. Impairment, compensation from third party for item of PPE that is impaired, loss, that fire, disruption, etc. should be included in P&L when compensation becomes receivable. Impairment of assets including the PPE are completely dealt by where A is number 58. Lastly,
So, in the car example, we recognize the asset long back.
so we have this last example you are saying. Yeah, we have to, technically speaking, in the scenario, we have to bring it as assets held for sale. No longer the assets were used with the production, no production. You can't produce. You can produce, you also cannot sell. So technically, those assets are no longer as held for use. It is to be brought as assets held for sale at the value on that particular day, and it is to be sold. That's all.
Today, I am able to produce the car. Should I reclassify it as
Reclassify into property, plant and equipment. But the company didn't went through that because by the time the 7 years of accumulated losses, they were completely figured out. So even though they won the case, because some other company which started late, group of other companies, they got the order from the Green Tribunal. But this company faded out, 7 years of sustenance they are not able to manage. So there was no going concern, they faded out, assets held for sale, sold, closed, shut. They went back to the foreign country. So in that particular year, the only option that was available is going by the near future, there is no growth. Going concern has to be questioned, and of course the assets are no longer held for use.
Do we charge depreciation for assets held for sale?
No, held for sale, no. It's only valued at that particular current value. So technically it is derecognized from the PPE category. Measurement, the following are the disclosure requirements. This is the core important part with respect to non-corporate entity, meaning you can just visualize a partnership firm for which you are preparing the financial statement, etc. What are all the disclosure requirements under this particular standards? Measurement basis for determining the gross carrying value, the depreciation methods that you are using, and bullet points under that particular paragraph you need to disclose. The useful life, range of assets, what is the useful life that you are following. These are the disclosure that is required even for a proprietorship entity balance sheet that you are preparing, forming part of the notes to accounts. List of assets in a table and what is the useful life. Gross carrying amount and accumulated depreciation. Reconciliation of the carrying amount at the beginning. In fact, there would be a great difficulty even in arriving at the gross carrying amount in respect of an entity. Even today you think to, because by and large in respect of a proprietorship or a partnership entity, you would be continued would have been providing a depreciation under the WDV method, adopting the income tax rate. Today even, you will only know what is the WDV. Sometimes suddenly the client comes and asks for what you call the pollution control certificate. They ask for requiring the value under the gross block. They would find really difficult to trace back 10 years before the bill and then arriving at what is called the gross carrying value. But at least on a slow and tradition, if you draw a line today, because that sort of little flexibility that we, unlike the company act, as far as a proprietorship or etc., somewhere we should draw a line and then start going for that. Maybe those assets which in respect of which you will not able to get the gross carrying value, take the today's value, and in respect of the newly purchased assets last 2-3 years, start disclosing the gross carrying value. So for all these data are available and continue to be tracked in the books of accounts, and that's the sort of the accounting. So even after 4 or 5 years, you will still know what is the gross carrying value. Reconciliation of the amount, that is usual table, the addition, deletion, asset classified as held for sale, business combination, revaluation, impairment, exchange differences. Now when an exchange differences, this is in fact a subject matter of discussion. Exchange differences arising out of your forex transaction to be capitalized as part of your cost. Usually, as far as the accounting standards, PPE as well as your AS 11, with respect to property, plant and equipment, our standards are basically a principle based standards, where these foreign exchange differences does not impact your efficiency with respect to the asset. And therefore, there is a very clear-cut rule that the principle based standards debit to the P&L only, debit to the P&L, unlike even your income tax rules, etc., which requires you to adjust the same to the carrying cost. If even under the income tax rules, except for your the 43A, more particularly your 43A of the tax laws, where an asset is imported from abroad and there is an exchange differences arising. These exchange differences at the end of the year in valuing and cert can be adjusted with the carrying cost of the asset, and only on the balance you need to provide the depreciation. That's for your tax laws. But as far as the accounting standards are concerned, these exchange differences always, with respect to the property, plant and equipment, are always debited only to the P&L for the simple reason that prima facie these exchange differences which arise to the geographical risk, countries, etc., does not going to increase the efficiency of the asset and does not satisfy your subsequent cost condition. Is there going to be a future economic benefit out of that same? The answer is no. Existence and amounts of restriction on title to assets is a separate disclosure that you need to do. Of course, the comparative information is also required. What is the previous year WDV, current year WDV, etc. Visualize this for a proprietorship making. Generally, we are afraid even making a comparative disclosure in respect of the financial statements, but the recommended financial statements issued by the ICI, if you see, it directs you to prepare, request you to prepare the financial statements in such a manner with the comparative information, and the same is been stressed here. Property, plant and equipment pledged as security for the liabilities, those disclosures are again required to be made. The amount of expenditure recognized in the course of construction, that is in work in progress areas. Contractual commitments which you have towards acquisition of property, plant and equipments, and any compensation due from the third party. See, these are disclosures required only in case where you go for the revaluation model. These are and during the year, have you revalued it, have you engaged independent valuer, these details are required to be disclosed. Effective date of revaluation, whether an independent valuer was involved, methods and significant assumptions applied in estimating the fair values, the extent to which fair values were determined based on observable prices, carrying amount of each class of revalued property, plant and equipments. In case you have done the revaluation only for an asset, a particular class of assets, have you done the revaluation for the whole class of assets falling under that particular basket? These are something which needs to be disclosed. The only relaxation available in respect of a non-corporate entity which falls under category 3 and 4, level 3 and 4, these are not applicable, but these are again In fact, I think if at all, if our mindset is to go for disclosure, even for proprietorship and firm in respect of these disclosures, these are just nothing. These are Pacha exemption, I would say. These are nothing. Having disclosed everything, these are nothing for seeking an exemption. They are saying for level 3 and level 4, in fact, they need not have to disclose this. Carrying amount of temporarily idle property, plant and equipments. If there are a bunch of assets, a particular class of assets, in case it's not being used in the production process, you just for namesake, you provide a depreciation. Those assets needs to be disclosed. It's more a encouraged disclosure as per the standards, which is sought to be relaxed in respect of a non-corporate entity falling under category 3 and 4. For each revalued class of PPE, gross carrying amount of any fully depreciated PE that is still in use, sometimes you'll find the asset will be live, but you would, by mathematics, it would have been fully depreciated. For 1 rupee, you would have been still carrying on like your typewriter type of stuff. For each revalued class of property, plant and equipment, the carrying amount that would have been recognized and the asset being carried under the cost model. In case you are following the revaluation model, what would be the carrying amount under the cost model? Carrying amount of property, plant and equipment retired from active use and not held but not disposed. These are required. These 4 items are the only, but for that, for all categories of the non-corporate entities, the whole standard is applicable. The whole of these paragraph standards, there is no any specific exclusion or relaxation or exemption given being a non-corporate entity. Such is the importance of this particular standards. I also thought, being a non-corporate entities discussion, the other challenging part comes with respect to, because mostly with respect to design of even your accounting practice with respect to a non-corporate entity would fall, keeping in view the compliance under your accounting with respect to income tax compliance and of course your GST compliance. So with the income tax, they are getting introduced to what is called the ICDS, the income computation, and though they are not accounting standard, because if you recall, they came out with, the CBDT came out with in fact tax accounting standards. So the ICA said, no, you cannot issue accounting standards. They named it and then said, okay, we will issue ICDS, income computation and disclosure standards. So some significant differences between the ICDS, because primarily being a non-corporate entity, that is what with company law would be pretty secondary, or even the which of the accounting standards. We would always look into the tax provisions. So therefore, what are the primary key differences between your ICDS 5, which deals with the tangible fixed assets, vis-a-vis the AS10 for the accounting for fixed assets? The definition of actual cost is narrow and may allow the taxpayer room to detect the expenditure on acquisition, whereas it should be capitalized. ICDS are more, the broad logic of ICDS is pay more tax as and when. So from that particular logic only, the ICDS, there's no concept of any prudence, principle, rather than accounting standard being more a principle based standards. So cost of fixed asset includes actual cost, non-refundable taxes and all other costs that are required to bring to its working conditions. When a tangible fixed asset is acquired in exchange for other assets, ICDS says the fair value of the tangible fixed asset so acquired shall be its actual cost. But whereas we saw that in case of your PPE, property, plant and equipment, asset coming in or going out, whichever is, you have the option clearly and evidently available, or you can adopt the cost model only if there are no commercial prudence, or wherever the fair value of the asset coming in or going out is not available, then you can go for the cost. When a tangible fixed asset is acquired in exchange for shares or other securities, the fair value of the tangible fixed asset so again shall be the actual cost. This is more particularly keeping in view the requirement of 43(1) of the tax clause, which talks about the cost for the purpose of the recognition. Fixed asset acquired in exchange for shares or other securities in the enterprise should be regarded as its fair market value or the fair market value of the securities issued, again whichever is more clearly and evidently available. When several assets are acquired at consolidated basis, the cost shall be apportioned on a fair basis, hence the might make the value very, very subjective. As far as your PPE is concerned, when several assets are acquired on a consolidated basis, the cost shall be determined by a competent valuers. 5-6 assets being acquired, you pay one single lump sum consideration. So how to capitalize build the computer out of that separately, your machinery out of that separately, normally you get a fair value or a valuation certificate and then you apportion the cost. But of course, the recognition, if you sum total all the fair value and it cannot exceed your actual cost which is incurred. The actual cost needs to be apportioned on the basis of the fair value of all these particular assets in proportion on the basis of the certificate. Of course, once this standard is covered, the 50% of the topic is over, being the largest of the three topics. The other two standards are little, very, very thin. You can probably cover it in a very short span of time. A16, moving on, very, very.
In the example of the bridge, is the bridge should be capitalized or can be capitalized?
It needs to be capitalized, yes, because there is a future economic benefits which comes out of the asset.
This thing that the PPE are tangible.
Because more particular.
I am not held, so that's where
more. I'm not.
The definition says PPE are tangible assets held. So there is no right which I have it on the bridge, because even if I close it, makes
the arrangement is for your use. Primarily why you incur an expenditure on the basis of the market practice is for your use.
And the schools which you said has to be taken to PNL, broadly under which head I will take it as a PNL, and is it a deductible expenses under income tax?
No, income tax law, it is technically disallowed because if it comes under your CSR, for example, in section 37 you would probably say it is not in relation to your business. The CSR itself is primarily not a deductible item.
Yes. So,
technically being, prima facie it is not a deductible item for the purpose of your tax laws. Because if you like again, time and again, this is the best practice. If you decide on accounting practices, if you always synchronize with your tax practice, the tax principles, then it would not fall in place.
Then obviously the assessee would try to capitalize it, at least depreciation can be claimed. I mean, that's how it will be.
But even if you capitalize, meaning as far as you are, see, with respect to the asset, the income tax law, there are situations even if an item is a PPE for your books, I can whole lot provide as an expenditure in my tax law if it wholly can be brought under 37. For example, in a leased assets, where whole item of expenditure is incurred, there are many judgments which say that an entire expenditure incurred would even be written off as an expenditure with respect to the tax laws. Tax is an entirely I'm telling another way.
Yeah. One more small doubt. You mentioned that, like, suppose the policy says that certain assets can be brought under
Expenses.
What exactly would be the head for that particular expense? Say mobile phone itself. I mean, under what head?
Your regular consumer office expenditure, or as mobile phone, meaning that would also go with your the company law principles, which says that any expenditure which increases above a particular threshold limit needs to be disclosed separately.
I'll disclose mobile phone asset.
Yeah, you can. So, for example, you cannot bring it fully under your office expenditure. If under the office expenditure, considering with your turnover, if it is more than that 1% criteria, I believe, on the turnover, then you need to disclose separately. Moving on further with respect to the borrowing cost, this is a very simple and very beautiful standard. Technically, whenever we incur an interest cost with respect to the borrowing, normally it would be taken to the profit and loss as an expense. The single most principle emanates from this particular standard is when the interest cost can be capitalized to the particular asset. There are two important criteria which are placed. One is the cost must be a borrowing cost. Second, an asset must be a qualifying asset. What are borrowing costs for this purpose? Borrowing cost includes a gamut of costs. Apart from your interest cost, it includes your commitment charges which you pay, incidental costs that you incur, for example, some 2% commission that you pay to somebody who gets you the borrowing, and all the other incidental costs which goes with respect to the borrowing, pre-closure, other agreed charges, everything. Borrowing cost or interest and other cost incurred by enterprise in connection with the borrowing of funds. And when you can capitalize these interest cost to the particular asset? An asset must be a qualifying asset. What is a qualifying asset? A qualifying asset is an asset that necessarily takes a substantial period of time to get ready for its intended use or sale. So normally we think that capitalization of this interest would only go towards your fixed assets or the property, plant or equipment, which is the asset held for use. But it takes into account by saying asset held for use or sale. So for example, let's take an inventory which is held for sale, and it takes a substantial period of time for its intended use or intended sale or intended consumption, and there is a specific borrowing for the purpose of production of that. The cost incurred, instead of debiting to the P&L, can be carried to the added to the cost of your inventory. This standard gives a beautiful explanation with respect to the wine industry, where it takes a substantial period of time, where in the manufacturing process of the wine, after it's ready, it needs to be stored in a particular state for the purpose of achieving the intended saleability conditions. AS2 does not permit it, but this particular standard permits it. And if you read the AS2, it says the interest cost, very, very fantastic. Interest cost is not an inventoriable cost unless any other standard permits it. So that standard is your AS number 16. So AS number 16 is a very limited role. So normally no asset, because normally your operation time of conversion raw material finished goods 6 months to 8 months, 12 months. Unless otherwise you can justify that particular inventory also takes a substantial period of time. See, as I said, you need to be very appreciative of the fact whenever a standard is written, these words like qualifying asset, substantial period of time, these are the one which makes the standard a principle based standard rather than a rule based standards. Not saying 80%, 90%, 20% as in terms of number. It goes by the logic, it goes by the principle, and gives a greater flexibility also depending upon the facts or circumstances of each and every case in deciding what could be even a substantial period of time. What constitutes a substantial period of time primarily depends on the facts and circumstances of each and every case. However, ordinarily a period of 12 months is considered as substantial period of time, unless and otherwise somebody could prove. I buy an asset or I do a construction of an asset, and it is going to take 12 months time for its intended use. I'm doing a project, that construction is going to take 12 months time. If it is only going to take 3 months time, whatever the borrowing cost, debit to the P&L. If it is going to take a substantial period of time, unless and otherwise someone says and could prove with the facts that a period even lesser or higher is only substantial in this industry, then such number can be taken into account. Otherwise 12 months time, where the intended use or sale is going to take more than 12 months time, going by the 12 months norms, then during the 12 months, whatever the interest cost, or till the time it is ready for use more than 12 months, those costs needs to be capitalized to the cost. For example, I am constructing a big mall, 3 years, 4 years of development. Mall is an asset for me because I am going to lease out the shops and get revenue, like your EA mall. It has taken 5 to 7 years for its intended use. I own each and every inventory shops, later then lease it out to the brands and get a rent. It's an investment in property which is again covered by your PPE, and whatever the borrowing I have done, because the intended use is going to take more than 12 months, over the period until the shop is ready and leased out to the brands, those interest costs should necessarily be capitalized to the asset and should not be debited to the P&L, and you can visualize in whatever the projects that you are handling and whatever the asset that you are facing. Now, in estimating the period, time which an asset takes, the technology, the commercial, the substance which is involved to get it ready for its intended use or sale needs to be. These are the factors which needs to be considered in determining what is going to be the substantial period of time. Now, having decided, so the first decision is there a borrowing cost? Borrowing cost is not just interest cost, all the other associated costs, but you need to ignore the imputed cost or the equity cost. Owner's capital cost or the equity cost is not a borrowing cost. Even your preference also, because fundamentally we find that now preference capital is undergoing the change. It is more a liability. If you read the Ind AS, preference capital is as good as the debt instrument, they are saying. Because in sum and substance, though for the company law purpose it's the capital in ownership, but there is a definite repayment. There is nothing called as redeemable and fixed return. It's more a debt character. But for the purpose of this standard, when preference capital also is regarded only as the owner's imputed cost and does not fall under the borrowing cost. So owner's capital cost and imputed cost, your internal reserves that you are using, imputed cost should not be used for this particular purpose. I would have invested this money outside, whatever the return that you would have got, etc., nothing like that. The actual borrowing cost should only be treated for this purpose. So is there a borrowing cost, number one? Number two, is there an asset which is under development and it is a qualifying asset? Just because there is a borrowing, just because there is a purchase of an asset, this standard does not come into picture. It must take a substantial period of time for its intended use. I purchase an asset and next day I am going to install and use it. Even though there is a prior period interest cost will be there, 2 months, 3 months of delay, but 2 months, 3 months is not considered as substantial. That is a debit to the P&L account. It has to be expensed off. The intended use must take more than 12 months. You are constructing a cinema theatre. When does the intended use comes? There is a shell, there is all the seating, screening, all, until it is actually ready for use. All the cost which is incurred till the time it is ready for use needs to be capitalized to the what do you call and there could be a bifurcated assets, furniture, fitting, this, that, etc. If there is only, and next comes the quantification with respect to the interest that needs to go to the capitalization. That depends upon whether the borrowing is specifically identified or not. If it is specifically identified, there is no problem. There is only one borrowing. There is only one bank loan for the entire project. You got an Indian bank loan for 100 crores at 12% interest. So with that you are going to do your building, seating and the screen and all that, then it is a specifically identified borrowing. But if you have 2-3 borrowings, then you need to do the weighted average capitalization rate computation. So you need to do the capitalization rate has to be on the basis of the weighted average cost of capital, and that rate should be used for the purpose of capitalizing the interest cost, which needs to be apportioned to all these particular assets for the purpose of the capitalization. So borrowing cost eligible for capitalization, the big paragraphs, but as I said, it's simplified in the following manner. Is the borrowing specifically identifiable or not? Specifically identifiable, each and every seating, I have spent 50 crores, 12% is the interest. So apply 12% on that, capitalize whatever the interest cost for that particular period. And 12% on 100 crores, let's say you have incurred 12 crores of interest during the period. 50 crores I have spent on seating, 50 crores, 12% you apply straight, capitalize. 30 crores on building, straight 30 crores, 12% apply, capitalize. But if the borrowing is not specifically identifiable, there is pool of money that have come, some money you are not able to specifically identify that this borrowing only for this purpose. So pool of money did come in a different basket carrying different interest costs. But all that pool that applied in for the purpose of your overall construction of the theatre as a whole, there is no one-to-one matching available. Then you go with the simple logic of overall interest divided by overall borrowings will give you what is the average rate of interest cost. That rate you need to use for the purpose of capitalizing every component of the asset is concerned. Two important principles, rather 3 important principles. while implementing this particular borrowing cost standards. Commencement, suspension and cessation. When do I commence the capitalization? Temporarily suspending a capitalization and cessation of capitalization. Now cessation is actually easy. Until what time you need to continue to capitalize and at what time you should stop it and take the interest cost to the P&L until the asset is ready for use. Asset takes longer period of more than 12 months, it could be let's say 3 years time. So I made the borrowing and started incurring the interest costs. So these 3 years interest cost I'm going to capitalize and the asset is now as planned, it's ready for use. Stop the capitalization and take the interest cost irrespective of the fact whether your commercial operations have started or not. Because the standard always goes with the principal logic of asset ready for use. Where comes the difference between your ICDS versus the accounting? Because as far as your income tax law, they go by what you call the put into use. Here you go with the principle of ready for use. So first with respect to the commencement, asset should commence the capitalization rather when all the following conditions are satisfied. Expenditure for the acquisition, construction or production of a qualifying asset is being incurred. Take an example of the cinema theatre, cinema hall, construction of the building, theatre, screens, seating. Expenditure incurred for those assets. Borrowing cost is incurred. When you should commence. Of course, the basic criteria of being a qualifying asset. Activities that are necessary to prepare the asset for its intended use or sale are in progress. What do you mean by the activities, like including your licensing, the fire approval, the registration required for the screening of the cinemas, whatever the local laws, the registration, license, the permits, other things, those administrative activities which are in progress. Once it starts all these three conditions, then you start capitalizing your interest cost to the relevant asset. Suspension. Capitalization of borrowing costs should be suspended during extended periods in which active development is interrupted. This is a very subjective paragraph. Now, I construct a mall. I expect 4 to 5 years duration. So whatever the, let's say 1,000 crores of borrowing I have done, the interest cost of huge interest cost, hundreds of crores, carried to the cost of the project, cost of the asset, rather than debit to the P&L. In between, there are COVID periods. Therefore, my construction got halted. Rains, floods, therefore construction got halted. And when there are rains, there are heavy floods, and you know very well how this construction with respect to the malls happens. They go 3 floors below the ground, where with heavy water logs, it takes them again another 1 month time to dewater it and then start or resume the construction. These delays which are involved. The question as to whether these delays, whether necessarily can be considered as interruptions with respect to the active developments. Just because there is a delay of 1 month. Meaning sometimes rains are during this particular, in a year, this month rain is expected only in this region. And as a result of it, there is a 20 days of delay. You can't say that 20 days I will not capitalize, I will debit to the P&L. So in fact, the standard itself gives this explanation. Water logging or water flooding, it's very usual in that particular geographical region, in that particular area. It's not considered to be a interruption at all. Because even during that particular period, you would be doing some administrative work. You will be doing definitely some administrative or paperwork or compliances would definitely be in progress. So you need to really consider whether those interruptions, a sudden licensing change norms. For example, I remember in Valasaravatham and Fortis hospital came. In hospital generally they permit, not exactly the numbers are correct, but this was the core logic. They permit up to some 5 floors or only something like that. as per the CMDA norms. But these guys have constructed it to some 7 floors. If you are having 6th or 7th floor, your core patient treatment things should not happen there. Maybe you can have a restaurant there, etc. But not the core patient treating thing should not be there. That's the CMDA norms. So they constructed some 7-8 floors, and it took them. They waited, in fact, for one government change to happen to get the license. So these are while suddenly the CMDA said we will not give the CC, the completion certificate will not be given because you have constructed 7 floors. So these are clearly a interruption. It's a change in the policy norms. They in fact waited the National Building Code to be amended. In fact, they did with the norms for 3 floors and they went 5 floors or something. They waited the National Building Code NBC to be amended and then they got the licensing from the CMDA. So you need to really establish, just because there is a 1 month of delay or 20 days of delay, that would not be considered as an interruption, and therefore you say that I suspend the capitalization. There is 10 days of heavy rain and therefore my production process have not happened, my construction activity got halted. For these 20 days interest I will revenue. Nothing. You need to continue to capitalize only. These are not, these are well known and these are habitual and these are cost to the implied risk with respect to the implementation of the project. So capitalization of borrowing cost should be suspended during extended period just because you initially expected 3 years and then it got now 3.5 years. Doesn't mean that half a year, which is extended period, you will not be suspend. It has to be, this is a very, but each and every circumstances you need to really evaluate based on the circumstances, the delay period, should I need to suspend or should I continue to capitalize. Cessation, as I said, it's a brilliant, simple one. Capitalization of borrowing cost should cease when substantially all the activities necessary to prepare the qualifying asset for its intended use or sale. So, moment the asset is ready for the intended use, you should stop capitalization of your interest cost. Sometimes, in order to not to heavily load the P&L with loss, at least because sometimes when there are pre-commencement thing, the tax authorities may disallow, or you just simply show the loss which will not be able to carry forward for a long period of time. You will want to, in fact, capitalize from a tax perspective, that at least you will be able to gain a depreciation out of that. That is again not being allowed, because the moment it is ready for use, you need to stop capitalizing and all the interest should only go to the P&L as an expense. And sometimes even you may carry a small paperwork during the day. Asset is actually ready for use. Some paperwork which is still pending. So interiors, wall screw roll is pending. In substance, the asset is ready for use. You should stop capitalizing the same. The disclosure is a pretty simple one. Financial statement should disclose the accounting policy adopted for borrowing cost, and of course the amount of borrowing cost capitalized during the. This is the 1 crore is the total interest cost have been cut during the period, out of which it pertains to the qualifying asset so and so, and that is being capitalized, balance has been expensed to the P&L. That's the only disclosure which is required. As I said, as far as your ICDS differences are concerned, which is very crucial with respect to dealing with the non-corporate entities, borrowing cost as per your AS 16 also includes your associated foreign the currency exchange risk. For example, the standard specifically says, when it defines borrowing costs, a very interesting wording on what are all the components which includes borrowing costs. Para number 4E says, exchange differences arising from foreign currency borrowings to the extent that they are regarded as an adjustment to interest costs. It's a very beautiful para. For example, I borrow, let's say $1 lakh from abroad at 6% interest. Now, at the end of the year, this $1 lakh, as per your AS number 11, you need to restate the closing differences, closing balances, applying your closing exchange rate. You would have recognized at X rate, let's say 80 rupees per dollar. Closing rate is, let's say, 82. So this 2 rupees, you need to restate it. The consequent loss needs to be generally provided to the P&L. So they are saying exchange differences, this 2 rupees on that $1 lakh, arising from foreign currency borrowings, to the extent that they are regarded as an adjustment to interest cost. So out of the 2 lakh rupees, 2 rupees on that $1 lakh, which is now a loss due to the exchange fluctuation, you need to identify an interest implied cost involved in the 2 lakhs. That will come under the definition of borrowing cost. How do you find that? The standard gives an illustration itself by says you need to assume for the same amount have you have done the Indian currency borrowing. Let's say it's a 1 crore borrowing. That 1 crore borrowing at the Indian currency would be, let's say, 12%. What is the total interest cost that you would incur? Let's say the exchange difference is 2 lakhs and this increased interest cost between the 6% to 11% is, let's say, 1,50,000. This 1,50,000 will only be regarded as an interest cost adjustment in the overall foreign currency loss. That would come under AS 16. And the remaining 50,000 will only go to AS 11. Your foreign currency fluctuation differences. So, in respect of your foreign currency borrowing, the restatement differences which arises at the year-end exercises which you do, out of that overall restatement differences, you need to identify what is the implied interest cost which is involved. That needs to be determined on the basis of assuming had it been an Indian borrowing, Indian currency borrowing, what would be the interest cost that is said to be imputed within this overall exchange loss. That would come under your AS 16. If AS 16 again, for example, it is not a qualifying asset, it will go to the P&L or as a capitalization. The balance will only go to your exchange loss differences which will be recognized in your the P&L.
So any specific rate is there? Now I have 5 borrowings with different rates.
Your cost of capital, debt cost of capital. So borrowing cost for the purpose of tax loss, there is no confusion. All this tax loss is concerned that there is no any, because as far as the tax loss is concerned, there is no question of any borrowing cost which does not include any exchange difference at all. As far as the borrowing cost is concerned, as per ICDS 9, qualifying asset means tangible assets, land, plant, etc. Intangible assets including patents, license, etc. Again, asset that necessarily takes a period of 12 months or more for its acquisition, construction or production. Inventories that require 12 months or more to bring them into saleable condition. As per ICDS, still qualifying asset is put to use. Capitalization shall be continued because that's your tax loss. Suspension of capitalization during interruption is not provided here. There is no question of any suspension at all. So as far as your AS 16 is concerned, look at the tax law, they are very clear, 12 months is the rule. Here there is no question of any, you assuming less than 12 months is also qualifying asset here or more than 12 months is only qualifying asset here. There is no question of usage of the word substantial period. They are very clear 12 months because it's a rule based provision. But accounting standard, it is principle based standard. They are saying substantial period and unless and otherwise provided, they are saying 12 months is reasonable, considered as substantial. You can still have an option of assuming less than 12 months also as substantial or greater than 12 months only substantial in your own case. For example, you can say 15 months is substantial in my project. So any asset which takes more than 15 months only I will capitalize, otherwise I will expense it in the P&L. That is something which is allowed as per AS 16. But ICDS is very rule specific, 12 months. There is no question of, and the importance of the use, you need to continue to capitalize as per your tax loss till the time it is the tax loss put to use. Actually you put into use. But the accounting standards, moment it is ready for use, even though you have not commercially exploited and then you have not actually put into use, you should stop capitalization of your asset. Lastly, quickly we will shut down this. Any questions on AS 16?
I have taken a loan for a particular asset to be constructed, but for some reason I have not started construction or not incurred any expenses, no activities, and that fund is parked in a FDF. Should I take borrowing cost and interest income net off and keep it as a pending borrowing cost, or take it to P&L?
Yeah, so I think the last slide which I have. A16 requires income from temporary deployment of unutilized funds to be reduced from the borrowing cost. The income from temporary deployment of unutilized funds from the specific loan shall be taxable as income from other sources under the ICA. So that makes it very clear. As for A16, you will reduce that from your borrowing cost. If at all an asset used to be, see, first of all, the capitalization commencement will happen only when the cost is construction, acquisition is incurred and administrative activities have started. And though the capitalization principle itself is not attractive, then it's only straight. It's only it doesn't come under the A16 itself, then it's fully your credit as an income, interest income, that's all. But having started the capitalization, and as you are saying, initially you got the disbursement of 100 crores, but then you started using only 20 crores, the balance 80 crores you put in the fund, then that particular income can be reduced from the borrowing cost. The ICDS says tax it as an income from other source. Revenue recognition standards provides basis for recognition of revenue in the statement of the P&L account. The standard is of course very simple, very important and beautiful standard, I would say again. As long as it remains as AS9, it is very fantastic, but under the Ind AS, if you see 115, they made it very so complex by way of providing the rules with respect to determination of recognition of a revenue and recognition of the revenue. 3 items: sale of goods, rendering of services, use by others of enterprise resources. When revenue needs to be recognized in respect of sale of goods. Number 1. The primary important point that needs to be kept in mind is when do you transfer the risk and reward. The risk and reward associated with the goods. Then that point if you keep in mind, because that's basically comes out of your Sale of Goods Act. The contract for sale, if you read the definition, it says the agreement for sale, and when it materializes as the contract for sale, risk and reward is transferred or not. Irrespective of the fact whether delivery is taken by the customer or not. Invoiced goods are identified, set aside for delivery, and the transport is the subject matter of scope of the customer, but he has not come and then taken the delivery. But for me, it is out of the unidentified goods, the goods are identified, set apart, risk and reward is transferred. Immediately sale can be recognized. But if your terms of sale is only after you take the electronic items which is being sold, your scope includes delivering, installing, test run, functioning, etc. and after the due satisfaction, then sale can be recognized only at that point of time, because risk and reward is transferred only at that particular point of time. This case is of unique importance, the word risk and reward, because in a very classic case that happened before the Mumbai High Court 50-60 years ago, where customer has not taken the delivery, but due to some fire accident the goods got destroyed. The question is now who will bear the risk? As far as me, risk and reward is transferred, even though you have not taken the delivery. Now more than from a revenue recognition perspective, it is more from, if you see from today the multiple arbitration cases which are happening before the court of section 9 cases, you will find that the courts have even started interpreting on when risk and reward is being transferred and at what point of time the risk and reward is transferred, and therefore the consequent losses therefore needs to be borne by the service recipient or the service provider or the supplier or the receiver. The possible arguments of course could have been, I have not taken the delivery. But the provider says, no, even though the delivery is not taken, the risk and reward is transferred. And therefore I am out of the risk, and therefore the consequent loss only you are required to bear it. Therefore this word risk and reward, when it is transferred, again, see, mostly in a very normal FMCG regularly dealt coach is very clear. You pay money, you take it. But in a very complex environment in today's scenario where the customized development of the goods and delivery, you need to be very, very proper, where you need to advise the clients on putting this very clearly in the agreement on when what is the arrangement between the parties in deciding when the risk and reward is transferred. because that is even important, even not only just from the perspective of the revenue recognition, tomorrow even from your GST perspective, etc. When is it considered as a sale? When it is actually considered as a sale under the Goods Act, Sale of Goods Act, whether the seller has transferred the risk and reward associated with the goods. So if the risk and reward is transferred, you can immediately recognize as revenue. Now, very popular example is where goods which are sold on sale or goods sold on sale or approval basis, where the goods are transferred, delivery even is in the premises of the customer, but the arrangement is that they will use it and then they will test it and they will have to give an approval for the continuous sale. Then only the risk and reward is transferred. So the sale itself happens by way of a formal approval towards that particular purchase. Then only it is deemed as a sale. So you are sending the goods, the delivery is already made to the buyer, is not an item for the purpose of recognition of revenue. He has to give a formal acceptance, or the arrangement by way of an agreement will specify that revenue can be recognized after the expiry of a particular time, or it's a deemed acceptance after 2 weeks time. Then only the revenue can be recognized. As far as, again, with respect to rendering of services, the standard prescribes also methods with respect to the recognition, completed service method versus the percentage of the completion methods. And that has been, this point has been a very significantly to be a disputed point when compared with your ICDS, more particularly in a service environment. So, and of course, you are used by others of enterprise resources, when do you recognize your royalty income, interest income, dividends income, these have been captured. Not applicable in respect of revenue arising from the construction contracts. This has been a very disputable point when construction is a core construction contracts. But today, if you take the people real estate who are also into promotion, so then it's not completely away from the AS9, because these guys are promoters, if you take any reputed builders, and also they either outsource the construction contracts or they keep the construction contract themselves. So there's also been a specific guidance note by ICA on these real estate people, where you need to combinedly use the principles given by the guidance note AS9 as well as on AS7 with respect to the revenue recognitions. AS9 is not applicable for revenue arising from hire purchase or lease, covered by 19. Revenue arising from government grants, which are covered by your AS12, and again revenue of insurance companies arising from the insurance contracts. These components are not included for the purpose of this revenue recognition. Mostly your unrealized gains, this, that, etc. have been, and realized gains on disposal of an asset, which is covered by your AS9 or AS10 has already given that is credit to the payment. So these standards does not talk about those revenues. Revenue is the gross inflow of cash, receivables, or other consideration arising in the course of the ordinary activities of an enterprise, from the sale of goods, from the rendering of services, and from the use by others of enterprise resources, your rental income, etc., or yielding interest, royalties, and other dividends. Revenue is measured by the charges made to the customers or clients for goods supplied and services rendered to them, and by the charges and rewards arising from the use of resources by them. In an agency relationship, the revenue is the amount of commission and not the cross inflow of cash, receivables, or the differences. You are a ticketing agency, etc., where the gross amount of inflows would be including the other person's imputed resources. So therefore, you receive 100 rupees, but you pay 90 rupees to the railway company. The difference of 10 rupees will only be considered as a revenue for the purpose of this particular standards. Definition of completed service and proportionate completion method is given here, but though the principles we discuss it, just see the definition alone. Completed service contract method is a method of accounting which recognizes revenue in the statement of profit and loss only when the rendering of services under a contract is completed or substantially completed. On contrary, the proportionate completion method is a method of accounting which recognizes revenue in the statement of profit and loss proportionately with the degree of completion of services under a contract. Main principles with respect to recognition of revenue. which are given in the more important para is the para number 11 and 12. Para 11 talks about revenue recognition with respect to goods, and para 12 talks about revenue recognition with respect to rendering of services. If at the time of raising of any claim it is unreasonable to expect ultimate collection, revenue recognition needs to be postponed. That's the established principle with respect to revenue recognition. Again, reiterating the fact, the seller of goods has transferred to the when revenue from sale of goods, para 11. The seller of goods has transferred to the buyer the property in the goods for a price or all significant risk and reward of ownership have been transferred to the buyer, and the seller retains no effective control of the goods transferred to a degree usually associated with the ownership, and no significant uncertainty exists regarding the amount of the consideration that will be derived from the sale of the goods. So if there is going to be an uncertainty with respect to the collection, the revenue recognition needs to be postponed. It's a twin condition. So one, risk and reward. Another, whether the collection is certainable, then the revenue recognition can be made immediately, or you recognize that as a sale. That transaction and event can be recognized as a sale in your books. There is no, with respect to certainty of collection, revenue should not be recognized. It can be postponed. Similarly, para 12. In a transaction involving the rendering of services, performance should be measured either under the completed service contract or under the proportionate completion method, whichever relates the revenue to the work accomplished. Now, under the ICDS, what is the method which is prescribed? Completed or let's for example, I'm doing an electric contract in a building where the 10 crore contract is given to me. I'm going to take 6 months time with respect to completion of the floor by floor. I need to do the electrical fittings. Now, let's say December the contract is given to me. I have taken out of 10 crores, 5 crores money. So, if I am required to follow the completed service method, so 5 crores which I have collected, I would have kept it as an advance in my books. Turnover recognition will be 0 during the current year. If I follow the percentage of completion method, since 50% of the work is over, let's say, then this 5 crore needs to be shown as a revenue during the current year itself. And the next year again I will show another 5 crores. Under the completed service method, the entire current year I will file my balance sheet as advance, revenue nil. Only when the work is over you show it as income. Next year only the entire 10 crore, once the work is over, I will show it as a income. So your accounting here does not go with your invoice, because the moment you receive 5 crores you pay GST. That's a different TDS reduction would have happened. That's a different story. You need to match. Today you need to follow the accounting. Sometimes you are bound to follow the percentage of completion method, because otherwise you need to then answer for differences between your 26 AS with your no profit and loss account, etc. But if you read the ICDS, they are saying where the duration of the work is going to take more than 3 months, you are bound to follow percentage of completion method only. So that's ICDS. But see, that part is very significant even in your GST law, whether it has been in determining whether it is a continuous supply, the question of 90 days. So as far as income tax is concerned, in a service contract, if the duration of the work is within 3 months, it's a chota work. For example, it's a 10-day work, I collect an advance. Let's say in the month of March I collect the money, but I'm going to complete it only in the month of April. I can show it as an advance. Show it as an entire income, you raise an invoice after the work is over. Next year you show it as an income, no problem. Tax guy is okay. But where the duration of the work is more than 3 months, whatever the amount you collect, find out what percentage of work is over. That much recognition should have been made, irrespective of money. If you are following again accrual accounting, if the contract is, let's say, 10 crores, you received only 3 crores. But 50% is over, then you need to show 5 crores. You are bound to follow percentage of completion method only as far as your ICDS, which is your tax loss. AS9 at least gives you an option of completion method or the percentage of completion. As far as revenue arising from the use by others of enterprise resources, yielding interest, royalties, dividends, should only be recognized when no significant uncertainty as to measurability or the collectability exist. These revenues are recognized on the following basis. Interest always on a time proportion basis. Revenue recognition, when we can take that interest income in your books on basis of the time. Royalties always on an accrual basis in accordance with the terms of the relevant agreement, whether you have received it or not. If it is on the turnover, as well as the other guy have incurred the turnover, you want to recognize the same as a royalty in your books, even though you have not received it. Dividends, when the owner's right to receive the payment is established, right to receive the dividend is established, that's your AGM declaration of the dividend. You have a right to receive the dividend. The standard also elaborates various other, in fact these are given as an illustration in the standards. AS9 is a very simplest standard which runs to only some 6 pages. But there are certain illustrations which specifically given with a rider that these are does not form part of the standards, because that may change from industry to the industry. Some of the very interesting the examples includes, as I said, on sale made on sale or approval basis. In case you are a installation and service provider, only upon satisfaction of the customer after due installation you can recognize the income. You are a person engaging in as a commission agent for media. When do you can recognize your media commission? They are saying only after publication or the relevant advertisements are released you can recognize as a income. But if your commission is on the base of the production, not on the base of the media commission, then moment the work is over you can recognize the same as a income. So the standard gives, including for example subscription for publication. You are receiving a subscription for publication, when to recognize the income. Revenue received or billed should be deferred and recognized either on a straight line basis. Times of India, you collect 12 months subscription. A customer has subscribed it in the month of June to June. So straight line basis, current year, even though I would have collected 1,200 rupees, for the current year I can only recognize June to March, 9 months, and next year I need to recognize balance 3 months. You are an institution which are running into coaching and teaching where you are receiving a tuition fees. Over the period of teaching period only, the revenue needs to be recognized. Not if at all you are following the cash basis, the entire income would have been accounted in the year of the collection itself. But you need to recognize the revenue on the basis of the teaching period, because in case of a lot of schools and colleges, the financial year differs from the calendar year, with the school opening and the reopening, the academic year, what we call it as, and therefore the revenue recognition should be on the basis of the academic year and not on the basis of the financial year. Some portion of revenue needs to be taken to the next financial year, maybe. The answer is yes. The proportionate tuition fee needs to be spread across the next year. Similarly, the services with respect to the storage, for example, recently I have come across an industry which collects an income in the form of storage of your stem cells. So, time 0 they collect few lakhs rupees. The guarantee is that they store the stem cells over a period of 10 years. So the amount that you collect today also needs to be proportionately shown as an income over a period of your 10 years. Apart from the regular recurring income also, that rental income also that you collect. Similarly, you are collecting an admission fees, entrance fees and membership fees. So if you are collecting an entrance and membership fees, revenue recognition from these sources will depend on the nature of the service being provided. Entrance fees received is generally capitalized. If the membership fee permits, only membership and all other services are paid separately. If there is a separate annual subscription, then fee should be recognized when received. If the membership fees is associated with certain benefits, then it should be treated as an advance. then as and when the corresponding cost is incurred in servicing the member, then the proportionate income should also be matched. So that there is a matching criteria, a matching principle is being followed as well, and therefore technically it says on the basis of the time of the membership, the revenue recognition has to be spread.
Entrance fees.
Agency commission.
Entrance fees. Entrance.
Entrance fees are generally one-time fees. If the entrance fees are not associated with any, generally will not be, then it should be taken as an income in the year of receipt itself. There is no question of any deferring the recognition on the basis of time. But membership fees, for example, you are entitled for certain membership benefits, free food for certain year, this, that, etc. Then you enroll for membership in the month of, let's say, September, and your membership is valid till the next September. So only 50% then I can take it as an income during the current financial year. Because balance membership fee is what you call the unexpired membership fee, in respect of which the cost will also be incurred next year only. So on the basis of the time of the membership fees, the revenue recognition should be.
So regarding stem cell, it has to be preserved for how many years?
I didn't know what is the law, the rule with respect to the validation, but there is a company which floated 10 years. It may be valid for, till life, I think it's readily valid. That's what the loss, what's called the research of the content I came to understand, but practically I didn't know. But this, I think stem cells is something which doesn't, I don't think so it carries any duration. But there is a company which said we will store the stem cells for 10 years. They collected 1 lakh in advance. Every year you need to pay some 7,500 rupees. So they came up for how do you recognize the income. So they said these particular 1 lakh also needs to be spread over a period of 10 years period. Don't take it as an income during the year of receipt itself. So disclosure is pretty simple again. In addition to the disclosure required by the accounting standards, AS1, disclosure of accounting policies. What is, for each and every category of our income, you need to specify what is the revenue recognition for services. When do you do sale of goods, what do you do? Sale of goods is standard paragraph, when risk and reward is transferred. As far as services, only very importantly, you need to say whether are you following the completed service method or the percentage of completion method. Very interestingly, as I said, compared with your ICT years, revenue from service transaction has to be recognized only in percentage of completion method for your tax loss. So to benchmark, as far as when you implement the standard for a non-corporate entity, you need to keep this, otherwise there will be a difference of a thing which you need to do in the memo. Exception, service over indeterminate number of acts over a specific period of time. Service contract with duration of not more than 90 days, 3 months time as I said. Where the rendering of service under the completed method is allowed. Small, you can remember a small contract. If you're doing a small contract, once the work is over, you do it. Tax authority is okay. Recognizes income under the profit and gains business of profession. Of course, ICDS itself is applicable because under the income tax law, you have an option to, under the head profit and gains business or profession, you have an option to recognize income as a cash or accrual, whichever is regularly followed by the assessee. ICDS is applicable only when you follow mercantile or the accrual accounting. But of course, ICDS for a non-corporate entity is very important with when you follow an accounting standard implementation for a non-corporate. Because for a corporate entity, anyway they have to follow only accrual in compliance with your 128 of the Companies Act. As far as ICDS on royalty incomes can be recognized even as per other basis apart from terms of agreement. If in case royalty incomes needs to be taxed yearly, as per that, show the income and then tax it. That's the idea. Royalty income can be recognized only as per the terms of agreement. Dividends are recognized as per the tax laws and as per recognition the right to receive is established. Interest needs to be recognized on time basis except in case of refund of tax, duty or cess, etc. where cash basis, only when department pays the interest, you offer it as an income. So that's about sum and substance with respect to AS9. Any questions on AS9? We'll take it up.
For an automotive distributor.
Or automobile.
Yeah. Cars and they generally bill at the month end or even for the target basis. Sometimes they get a delivery receipt from the customer saying vehicle has been delivered, but registration is still pending. In that case, should I recognize?
Yes, the central fundamental idea is you ask yourself a question. If supposedly you build it and then send the car.
No, car is still there.
No, car is
Still there.
tomorrow if something happens to the car, who will bear the risk?
The customer has given an acknowledgement that I am the responsible.
No, you have not just from the revenue recognition perspective. As I said, you also look at the legal perspective. If some damage happens to the car, from a legal contractual obligation perspective, you answer yourself a question. Can you will say, okay, I will bear the loss. Or no, I already transferred to the dealer. Right? Usually the OEM does to the dealer. So I've already transferred to the dealer, it covers under your insurance only. If you say that here, then risk and reward is transferred. And therefore the revenue recognition will go.
Registration is not the
Registration is not required.
But I don't
The
think
registration is only a permission for driving a vehicle on the road. I can always buy a luxury car and keep it in my home front. I'm not going to drive the vehicle on the road. Registration is only a permission to drive the vehicle.
But sir, the point number 2, the second condition that the revenue should be there should be a certainty to receive the money.
Yes.
Now, if something happens before the
That's
registration
what
is
I
not given, I don't think the buyer is going to give you something.
No, his question is for the purpose of revenue targets, normally they deal with the distributor arrangement to book certain vehicle. Even though they will say the deliveries will be postponed to the distributor in next lot. The question is again now is, forget about this. If tomorrow there is a fire accident in your premises and that those 10 car units gets damaged, can you say that the distributor only will bear the loss? Or you will bear the loss? This answers your question as to risk and reward. The central one-line function with respect to this is only when a risk and reward is transferred. If risk and reward is transferred, then sale can be immediately recognized.
The insurance claim is there.
Sir?
For damage of the car,
Ah.
insurance claim will be
That
there.
insurance claim is also whose insurance? Is it your insurance or you will claim under that? You will say simply say, yeah, fire damage, but you claim under your insurance because I have already transferred the risk. Dealer's insurance. So the question is risk and reward. In accounting, maybe for GST, what is relevant is your invoicing. When you need to mandatorily the invoice, your e-waybill, lot of stuff. But for accounting, it's purely go by the law, risk and reward. Irrespective of your possession, whether it is transferred or there would have not been even e-waybill, maybe synchronizing with your GST. Just because an item is suffered a GST and transferred doesn't mean that there is a sale. Though logically, in 90% of the cases, it would have been a sale.
Thank you so much for wonderful session, sir. Srinivasan sir come to dais and given a vote of thanks, sir.
Excellent presentation.
Thank you.
I thank SIRC for providing me the opportunity to present the vote of thanks. Thanks to Sundaraman sir for the thought-provoking lecture on AS9, AS10 and AS16, and also thanks to all the members for the patient hearing. Thanks.
Thank you.
Thank you so much, sir, for wonderful